Hey folks, my name is Jeffrey and I am the founder and co-partner of PowerEmini.com. We started that, Bill McKinley and I of Investing Systems started PowerEmini 10 years ago. Today what I'm going to talk about are some of the keys to reading market profile on the intraday time frame. So this will work for day traders of stocks, day traders of the futures market. You can apply this to other things like oil and also, the Forex as well. So this is kind of, I'm going to show you some universal concepts today, and basically some of the techniques that I use to determine market profile for each of the sessions. Now, a little bit about myself. I come from a several decade career as a software developer, corporate accounting systems. I've done like automated scheduling systems for factories. I've done stuff for defense contractors. So I spent quite a few years cutting my teeth on some of the most sophisticated software systems out on the West Coast. And at one point I had my own software company with programmers. And I've always had a love for the market. So gradually I shifted my skills over to researching, analyzing, and developing systems and strategies for the markets. So I've got 2 decades of just software development for trading systems under my belt. That being said, so what I've done is, I've transitioned over the years, the last 10 years or so, to only focusing on the markets. I trade my own accounts. I run PowerEmini.com, and as well as continue to develop and research new types of strategies for trading. Now, what we're going to talk about today is kind of a easy way to visualize a market profile. So when you hear about market profile and volume profile, you usually see these kinds of complex charts, letters and numbers, and these charts are used for determining volume levels and how much volume gets, how much time price spends at a particular level and how much volume trades there. And so what we're going to do is we're not going to get into this. This is a very complex type of genre, right? It's its own little animal in the market analysis. And you usually have to go off and dedicate yourself. And there's different schools of thought about volume profile charts. And so it's kind of like Elliott wave. There's different schools of thought about which works better, different angles. And just like anything else, there's trading methodologies to utilize with the market profile volume charts. However, everything has a failure rate. So basically when you jump from one thing to another, you end up just trading one failure rate for another failure rate. Okay, so what we're going to do in today's webinar is we're going to take a look at how we can analyze market profile for ourselves without getting into all the volume profile analysis, right? Just using standard charts and standard tools. Now, let's spend a little bit of time prefacing before we get into that topic towards the middle and talk about basic trading concepts that come into the mix when you become a regular trader. Now, it doesn't matter if you're a scalper, if you're taking positions for an hour at a time, or you're trying to ride the whole session, or you're a swing trader. These same concepts apply to you at your level. And so the first thing is that when we break it down, we get 70% technical price action, and the other 30% is news driven, right? So that means that all of our best efforts at technical analysis only get us about 70% of the way there, right? There's always going to be a news event that comes in and throws the market into a tailspin. Today's perfect example, if you were watching the markets today, you saw that, we prodded to the upside, we prodded to the downside, when the market attempted to make a move to the downside, that was rejected, and we pushed a little bit higher, and then the market looked like it had built support and it wanted to push a little bit higher today, right? If you were watching the markets, and the markets took off, and then one tweet sent the market into a ginormous plunge, right? So if you had been getting long when the triggers were saying, hey, this is a long level here, then you got hit by that big market reversal. And then the other thing, if you were trying to short initially early on in the session today, which the signals and the alerts were there to do so, you notice that in the end, you would have caught a ginormous move, but in the middle, you got stopped out. So anyway, the point being is that everything we do in technical analysis of the markets can be upended by a news event. All right, so let's keep that in mind as we go forward here. Now, when we create any kind of a trading strategy or trading system, and we start to build rules that we're going to follow, right? We're trying to get away from the random entries where you just jump in at gut feel, and use some kind of methodology of how we're going to take our entries, where we're going to look for exits, that type of thing. Every single change, tweak, enhancement that we make in different parts of our system is going to be like a Rubik's Cube, and it's going to tweak something else, right? Either for the positive or the negative. So, and this is a classic dilemma in building trading systems and this is where over-optimization comes in, where we basically, we keep tweaking so much that, yeah, we prevented getting stopped out, half a dozen times, right? But then we missed two ginormous entries that made us bank earlier, right? So you can basically shoot yourself in the foot. So when we design trading strategies, we want to basically put together the best stuff that works in the simplest way that's going to get us our objective, right? And if we go overboard, then it can work against us. Now, another key concept of trading is that we, as traders, hopefully we don't come in and we bet everything in the farm on one bet, right? We don't do that. We trade over the series, right? Most people want to make trading their business or their hobby every day that they follow and, make money. So you have to think of trading over the series. A minimum series that you would want to look at with any kind of strategy or setup would be at least 100 entries, right? That's going to give you a decent idea of what's happening. And not just entries, let's say you had some kind of scalper that took 100 entries in one day. Well, that might work like a charm on one day, but every other day it fails. So you have to test it on lots of different days of price action. So, but one of the important concepts is that the real way to build an edge in trading, and it's not easy, trust me, this is why as you hear, most traders fail. They cannot get into the groove where they create a profit edge. They just can't do it. So the important thing is to build a profit edge into your system or strategy and your money management, and then over the series that gradually increments profits. Okay, that's the concept. And so when we think about any kind of systematic trading approach, you want to think of the big series. What if I follow this, how is it going to look 1,000 trades from now, right? What are the ratios? Now we have volatility in the markets. Volatility refers to the price jumping up and down, basically. I remember reading early on, 30 years ago maybe, in a book about trading, and it was all about trading setups and strategies and this and that. And the author made a point in the middle of the book somewhere saying, the biggest challenge we face as traders is the market volatility. And I remember thinking to myself, well, why would that be? Because volatility, it's, that's good. It's price movement, and you just take an entry and you place your stop, and what's the big deal? So all these years later, I realized that that statement was absolutely correct. One of our biggest challenges is current volatility, and volatility is not price movement like from point A to point B, but it's the amount of wiggles within that movement of point A to point B. So if we had a range of, let's say, 10 points, we might see price just kind of like stair step from the lower point of the range up to the upper right part of the range, right, in a kind of a controlled manner, low volatility. Or we might get the price spike halfway up, come spiking halfway down, spike back up again, wiggle all over, roll around, and then shoot up to the top. That's volatility. So we have sweet spots of volatility in the market. And this is the volatility that is conducive to trading. It's just enough volatility that where price is actually moving, right? You'll see price like make little leaps, and then there's continuation, and that's good volatility. And that's the kind of volatility that gets the trades moving in our favor. Then we have super low volatility, where either nothing is going on, where we don't even get any triggers, or we get triggered into a trade and then it was just a fake trigger, a false trigger, a little blip, right? And the trade just doesn't do anything. Price comes right back down and maybe drifts down to your stop. Then we get super high volatility, which you'd think, well, we got lots of price movement, but price is zigzagging so forcefully that it can slice right through your stops and then turn on a dime and go right back in your favor, right? That happens. I mean, that's a common theme of trading, is we get hit like that once in a while. So we're always contending with these three levels of volatility in the market. So when we talk about trading outcomes are not just win or lose. We have different flavors of the follow through of our trades over the series. So let's just pretend, we started several months ago and we're 200 trades, or 300 trades into our trading, right, over the series, depending on how we're taking trades. We're going to see these types of four outcomes. We're going to see, the full stop out. That's where, news can do that. Like I just mentioned, a dull market, we just get triggered in on a little blip, but then we just drift back to hit a full stop. There's no energy. Too much volatility takes us out. All right. Or just, if you take just sloppy entries, right? Gut feel entries that are just, when you look back at them, they're just totally wrong. You don't know why you took them. They lead to full stop outs. Now we get lots of trades where maybe depending on your trailing stop, or if you're taking a half of a target somewhere and then moving your stop to break even, or just following some kind of trailing stop methodology, you actually can get to the point where your stop comes up to your entry. So you've got to draw, right? You get knocked out, but no harm, no foul. Then we're going to get trades, let's say we are doing like a two-stage scaling where we're just going to go for a relatively easy target and then try to hold the rest. Well, we may hit that first target, and then because we made that move and maybe a little bit more of a move, our trailing stop gets to break even, so we end up with just a first target on like half a position, let's say. And then we get the big full-on runners where we can lock into something. We hit our first targets and then we maybe hang on, get to break even. And depending on your holding time, we can get ginormous, runners. All right. You may stay in for an hour and catch a huge price surge. You may stay in the full session and ride out a full, long range day. So these are the trading outcomes that you're going to experience. It's not just a win or a lose. So here's a kind of a graphic of what we're looking at. Over on the left, you take an entry, price never even goes in your favor. It could be news, it could be dull markets, could be volatility. You're out, stopped out right away. And then we get the break even. Maybe we get a little bit of a movement in our favor, enough to get our stop tightened up, but no further movement, we get knocked out. And then we can get where we get our first target, and then on the right you can see the full runner. So in your mind, this is what we're dealing with over the series. We have to, these are our 4 results we're going to see in the trading process over the series. Now what we'd like to see is we'd like to see our trades pan out something like this. We'd like to see more winning trades versus losers, right? You've heard that, oh yeah, you could, you don't have to win all the time. You could actually lose more than you win, but you could still make money because you'd have big runs, right? Yeah, that's true. That works good in investing or swing trading a lot of times, where you can really let things run. But in day trading, we'd still like to see more winners than our losers, right? And then we've had break-even trades in there. Those are the trades that, we got some forward movement, enough to protect our position in one way or another, and no harm, no foul. We get knocked out of those. And then we get losing trades. And those could be either full stops or just partially losing trades. Maybe your trailing stop tightens the stop by half before you get knocked out, right? So the real breakdown is not win or lose. That's why when you see these, 97% win rate, yeah, you have to be very wary of those kinds of percentages, because they don't really make sense in the process. You can see here we only had 58% winning trades, but that's okay, because look at how the other trades broke down. That didn't mean all the rest were losers, because we broke down into break evens. And so this right here, we had more winning trades. Now, the other thing we want to see, we'd like to see our winning trades be bigger than our losing trades. Now, obviously, you can't do that every trade, but what you do is you look at an average, right? So if you're 20 trades in, you go, okay, if I average all the winners, average all the losers, hopefully my winners are bigger than my losers, right? So we're striving for these 2 ratios in our trading and trading the series. Now the trading results over the series, we want them to look like this, and if we have the correct kind of a strategy that we're following that has an edge, then we'll see something like this. And how this works is, let's pretend these are just individual trades. You can see over on the left there, we can have a small win, a small loss, but they kind of cancel each other out. So we're treading water, right? We're trading at or around break-even level, okay? But our strategy gets us into some big moves, and so we are able to catch some big winners. And you can see that's where we push past the threshold of the cancellations and also the commissions, and we get our net gains. Okay, so when you trade systematically and you trade over the series, the whole bet is on over the series, you're eventually going to catch some bigger winners, right? And this is one of the reasons why scalping for fixed points or fixed distances, just very small, is a really, really difficult way to achieve a profit edge. It's really hard. You always have to win more than you lose, right? And it's very difficult. So this is why we typically want to open up trades at some points where we let them run in our favor. So we have 3 reasons for poor trade performance. One is, let's just review them real quick. One is, I mentioned, sudden news spikes, right? We could get into a trade, it's a perfect setup, ding, tweet, like boom, market goes against us and it knocks us out. Today's a perfect example. A low energy market, that's where it's just so dull, a little blip might trigger us in, and then there's no energy and everything just fizzles and never follows through, never makes it into the textbook. And then Trading without context. Now, this is where I'm going to get into talking about market profile a little bit. Trading out without context means that when you're day trading, you're just kind of maybe willy-nilly picking spots to take entries because it looks good, or maybe you've got some favorite newfangled, moving average crossover setup that you have on your chart, and it's giving you long signals, it's giving you short signals, but you have no other context other than those couple moving averages, right? You're going to have poor results over the series because you have nothing to filter out those setups, right? So building a context around the market behavior each session can help you filter out which one of your setups should you take and what direction should you be trading. So real quickly, let's just talk about the different day types. I've done a lot of analysis, computer analysis. I downloaded 10 years of market data and ran analysis on different day types because you can go out there and read about all the different market profile types, and they break it down into some people break it down into 24 different types of day types, and that's just a little bit too much to make useful, right? Maybe technically, yeah, you can break it down like that, classify it like that, but it's not going to help us. So I wanted to break things down into the bare basics. And so let's just take a look at like trajectories. If we use a very basic concept of just like, okay, as soon as the market opens in the morning, we're going to use the opening price level as our visual reference point, okay, nothing more than that. We end up with different trajectories over the different sessions. And so let's just go through them real quick. Number one is a day where we just blast off immediately from the open in one direction or another. That could be a kind of a news-driven thing. It could be a gap-driven thing, but the market just takes off, never looks back, and we make a giant move, and maybe the market plateaus, and that's it later, right? But it was a huge move right off the get-go. Another kind of a market is kind of the steady trending day market. These are like the big long range days that when you look at them on the chart, the daily chart, your open is at one end of the range and your close is at the far end of the other, right? And just price travel the whole distance. And so these days can move in several plateaus where they go up to one level and consolidate for a while and continue. They can kind of stair step up, or they can run up in big waves. But the general idea is that they're the super strong trending days. Number three is the V reversal day, where we might get a trend move early on in the session, but then we get a big reversal in the opposite direction, which can go all the way back to the opening price level or even past it and continue, right? Big V reversal. So you end up with good trading action in both directions if your trading strategies take advantage of that kind of stuff. Number four is, well, let's talk about number five. Five is a completely flat day. That's usually around the holidays or some other strange event that would, markets would just be dead. Maybe like a half-day holiday thing, and there's no pulse, right? So you shouldn't even be at the computer. But number four is the day that gets us into trouble. Number four is the day where we get trend failures. Today is a really good example of where the market failed each time it tried to break out to the downside, failed, tried to break out to the upside, failed. Then we got that big news spike. So we had kind of a four until it turned into like a big market drop. But the point is that it's just enough energy to start triggering in like breakouts, even like breakouts and then pullbacks, but then there's no continuation. And so these are the kind of days that get day traders into trouble. So that breaks down basically to three levels of market momentum. The high momentum days, we get strong follow through, right? You plop entries in and short time later, they've they've moved on, right, in your favor. Weak momentum, no trade triggers, nothing. You can sit there all day and just according to your rules, nothing's triggering. That's fine. You sit on the sidelines that day. And then the medium momentum is where we get a lot of the false triggers. Market day types. So market day types, these kind of show you what we've just been talking about. Big long range days where we open at one end of the range and then we close on the opposite end of the range. Over on the far right are, well, in the middle, I'm sorry, are the key reversal or V reversal days where we get like big, on the left there, you can see in the middle, market open, big push down, and then it turned around and reversed one all the way back to the open, and vice versa on the one on the right there. And then on the right are our little doji bars where the open and the close end up around the same. And these are the ones that where we have a lot of false triggers. All right. Now, one thing that's important to understand is as you trade through the series, you cannot help but notice, if you trade month after month, year after year, that the big money days are the long range days, right? Doesn't mean you can't make money on other days, but if you're a trend trader and you have the correct positions, this is where you can really clean up. And a lot of it has, it's nothing more than being able to get into a position and hang on into the close, right? Right towards the close, and you just exit your position and you will catch it. You'll catch the big move. And there's a reason for that is because on a big long range up day, for instance, a lot of times we get short squeezes into the close because amateurs come in and say, oh, look how overvalued the market is. It's got to drop. And they're in there shorting right before the close, hour, 30 minutes before the close. And the market ain't going down. It keeps hitting their stops. And so they get squeezed out and it's just pouring fuel onto the fire. So markets can just keep pushing all the way into the close. And then vice versa with the big sell-off days, usually those occur because there's panic selling. People are panicking all the way into the close, trying to sell before it's too late. Musical chairs, right? And so we can get selling occur all the way into the closing bell, price moving in that direction. So if we look at like the typical daily price bars, and this is, what is that, 10 days or so, you can see the different types of price bars that we get. This is typical of the S&P 500 or the Dow. You can see, and I got it kind of labeled with some of my terminology there. Trend long on the left there, you can see big money day, open is at the bottom of the range, closes at the top. And you can see that the amount of money that can be generated a lot of times has to do with the range of the bar. You can see over on the far right, we had big down move there. So what can we do then to understand, when the market opens, what can we do to build a market profile and understand how the market's going to behave that day, maybe what direction it's going to pick, and what can we use for visual reference points. Now, once you're going to notice this behavior a lot, once the market can make a clean break of whatever that market profile is for the day, and today's a good example, when we sliced right through the bottom range of today and then just kept on a trucking, the market can run in a massive way in your favor. So the key is, how can we temper ourselves at the open? Because the worst mistake you can make is to jump in right at the open without any context, right? So timing of the entry is critical. You can see here, let's say that after the open, we went in and said, hey, my my little indicator says go long, and my gut feel says go long, and the general market bias looks long. So I want to get long and go from point A to point B, right? And you're absolutely right. But with premature entries, you could see you could get stopped out by wiggles. Okay. And guess what? Exactly what happened today to the short side. Had a move. The entry itself wasn't technically premature, but it's just because of the market volatility today. But the point is that precision of our entries, the timing of our entries is real important, because you can see here, this trade failed, but if we had just known to wait to take an entry here, that went to target like we had guesstimated. Now, real quick, we get different types of markets. We'll get a market that comes off the open. It's very stair-steppy in one direction or the other. So you'll see it'll push up to one plateau and then kind of consolidate for a while and pushes up to the next level, right? You may or may not get pullback alerts on these, because if the levels are very narrow, you're not getting any pullbacks, but price keeps going higher. So this is where breakout entries will pick you up. Then we get cyclical markets. We get cyclical markets where the market swings wildly in the up direction to the downside, or crisscrossing the opening price level. Then we get a spiky market. And today was kind of a spiky market where we kind of zigzag up and down and crisscross the opening price level and test highs and lows. So this is another reason it's not easy to be a day trader, because we're constantly in a shifting environment. And the market might be behaving a certain way for 3 days in a row, and everything lines up, and you feel like, oh, I finally got it. And then our market environment shifts on you, and then the next day you don't got it, right? So we're in a constantly moving type of an environment. Now, here's how it kind of breaks down based on our momentum system that we have. 20% of the time we have strongly trending days, either to the upside or to the downside. So you could basically, 10% usually is going to be upside over the big series, 10% to the downside, long range days. 50% of the time are going to be weak trending days, where either we make kind of a half move in a certain direction, right? So it's a narrower range day, but it's still in one direction. Or we get a V reversal, where we get a strong move in one direction and a strong move in the other. That's still tradable. We make money. 30% of the time are trend failure days. These are where almost no matter what you do or whatever kind of strategy you do, traders are going to get tripped up, and you get thrown off balance. The market just doesn't want to behave that day. It doesn't want to be your friend. So the other concept in trading is that we get the dilemma of, do we go for the big move? Do we go for the small moves? Because, a bird in the hand is worth two in the bush, or, let your winners run, cut your losers short approach. So the answer is they're both valid in and of themselves, and they're better when you mix the two, right? If you want to be I think, build a better edge in trading, you've got to open things up. You can't be just a scalper of small moves. Occasionally, you've got to open things up and let them run. On the other hand, there are times when, if you're trying to just let things run, you're not going to make any money, but you could make money if you're taking smaller targets. So there's a way to mix the two. All right, and this shows a basic, what I call a delta target trade configuration, and I started using that terminology a long time ago. Basically, it says, if we take an entry with multiple contracts, or a certain number of shares you can split in half, take half off at an easy target or a reasonable target, and then you can bring your stop up equal distance outside your entry of your gain, and then you're at a virtual break even. This is a great way to if you have precise entries, right, good timing on your entries, precise entries, this is a good way to be able to plant positions in that can run a little bit further, because you take all the heat off. Once you hit that first target, you take the heat off, you can sit back and, you know, not worry. One of the main concepts when we're day trading is we're trying to stay out of entanglements, right? We don't want to trade against them. And like on the right there, you can see if we're totally entangled in them, we just want to sit on the sidelines. So this is where we get into the concepts of market profile. The other concept in day trading that you want to think is that, and here's like a football analogy, is that based off of the open, price is going to want to run in one direction or the other at some point in time. They're going to try to run the ball towards target, right? And you got to know where you can get in and maybe how far they're going to run the ball, right? Downfield. And so the whole idea is, and this is the way I visualize this in my head every day, when we get breakouts and we get moves in a certain direction, it's like, okay, we're moving the ball downfield and, we're hitting resistance, just like a football game, basically. Now, one of the first things we can do is, I mentioned the opening price level. The issue with the opening price level is we can get price zigzag up and down past the opening price level, and plus we can have a day where the price stays stuck in a range around that opening price level, and you can get chopped up in your trading entries. So many folks use a 5-minute range. This is where we basically just real simple. You can use a 5-minute bar chart on one of your charts and just you wait for the first 5-minute bar to complete, put a horizontal line on top, a horizontal line on bottom, and that is the range you stay out of, okay? One of the things that we're looking for then is if price has the energy after the market moves around for 5 minutes in the morning, if price has the energy to be able to break out of the range, then that's telling us where the energy is, either to the upside or to the downside. Dave, quick question. You there?
What's up?
Yeah. How am I doing on time? Like 10 minutes? I don't have anybody after me, so am I cool? 10 minutes?
Well, I'd like you to wrap up as close to possible as you can because the clock's ticking on the.
Well, right. So 5-10 minutes.
Okay, yeah, that's fine.
Okay. All right. So yeah, I'm in the home stretch here. So one of the tools we can use is we can look at a opening range of the market. Now, some traders use, use real tight ranges, the first 2 minutes, or you can do 5 minutes, or you can do 10, 20-minute ranges, right? You can even go out to the first 30-minute range. So there's different ranges that can be used, but a real basic one is just the first 5 minutes. The next thing we can do is you can also take a look at pre-market activity. Why don't you look at the previous 30 minutes of pre-market activity? So what that would mean, if you're looking at stocks, because stocks close and they can gap between the sessions, you want to look at the previous day's final 30 minutes of trading. With the futures market, since it's running overnight and pre-market, you just use the 30 minutes of pre-market. And the final thing I'll just give you here in this seminar is plain old 100-period EMA, right? Now, just those 3 things alone that I just gave you, right? You can experiment with those on your charts, put them on a 5-minute chart, put them on a 1-minute chart, whatever charts you look at. 5-minute range, previous trading range of 30 minutes pre-market, and a 100 EMA. And those 3 things alone are going to give you a good take on the direction for the session. All right, so in the morning, what we're basically trying to do is figure out where is the noise level and where is the point where the market wants to break out. We'll just go ahead and skip past a little bit here. Here's a little freebie I'll give you. It'll take a minute to describe this, just so you get another takeaway out of this seminar here. Regardless of what your strategy is or how you're taking trades or what type of charts you're trading on or what time frame you're trading on, a little trick to use to know when to get to physical break even, that's where you actually drag your stop all the way to your entry so you can't lose, is what I call the 3-bar trigger. Let's say this is a 1 minute chart here. So let's say if you're taking your entries off a 1 minute chart, you wait for 3 lows on those 1 minute bars to be above your entry, and then that's your trigger to go ahead and get to break even. Works on a 5 minute time frame. This works on the daily time frame for stocks. This works. It's ubiquitous. So this is one of your little takeaways. This can be plugged into any kind of trading that you setup that you have. Now, I mentioned Bill McKinley of Investing Systems and I are running poweremini.com. We've got a really cool piece of alert software for the E-mini futures, and it's the ES, NQ, YM, CL, and the 6E. We've got 2 algos. And just real quickly now here, I'm in the home stretch. The 2 algos that run for each of the symbols are, we call it the power scalper, and you're going to get lots of small scalp alerts that you can trade, maybe up to 20 alerts per day. And then we have the momentum breakout target system, which is geared towards trying to get you into the main momentum of the entire session with big targets. So we get up to 1 to 2 alerts a day, and the idea is to catch like grand slam home runs. We have a whole strategy built around each of these algos that you can plug into. So here's an example of the momentum system getting you in, trying to keep you in for the big move, whereas the scalper is going to give you lots of scalping entries on the way there. Okay, we'll skip past this. You have the ability with the software to go in and turn on and turn off which channels you want to connect to. Now, the cool thing about this alert software is it is platform independent. Whatever platform you're trading through, whatever charting system you're using, this is separate. It's a third-party piece of software. So you're going to get this alerts and the signals, and you can still trade on whatever charting platform you use. In addition to that, we have developed for Ninja 7 and Ninja 8 a companion indicators that also receive the same signal. So if you are a Ninja user, which a lot of people are, then for trading the futures, then we give you this no extra cost. You get the software and the on-chart indicator. And basically it works around a concept which I developed, called the dynamic trigger range, where the software is constantly computing ranges based off of our various algos that are running, and then giving you those alert levels throughout the trading session to work with. Right, and that's what it looks like. It is a little standalone piece of software. It just sits on your desktop, and you have audio you can turn on and off. You can open up as many channels as you want, but usually people pick one symbol to scalp on, let's say, and maybe they pick one symbol to trade the momentum, so they just keep 2 channels open. You can pop over to our website at poweremini.com and just type in your name and email there, and we'll send you like a freebie PDF I think we got that shows you some other trading tactics and another video with some other intraday trading tactics you'll get, and then we'll keep you abreast of like any other future webinars and stuff that we're doing. You can also, if you have any questions, you can email us at info@investingsystems.com. And we have a really reasonable way to sign up, no big upfront costs. You come in, you sign up for a month. If you don't like it, you can cancel at any time. You're not billed again. If you love it, you just stick around with a very reasonable monthly subscription fee. and you have access to all the training videos, training materials, plus the ongoing training that we do, and then your alert software, which runs 24 hours. And that's it, Dave.